Welcome to yet another episode of the Sustainable Finance web series. During the course of 5 episodes, I will share some insights on several EU initiatives which intend to accelerate the transition towards a climate-neutral economy. Like every episode, let's start with a quick recap of the previous episode, in which we talked about the EU taxonomy. It is a classification tool aimed at investors, companies, and financial institutions, which you could compare to an encyclopedia of economic activities that have a direct material impact on climate change mitigation and transition. It provides assessment criteria and logic to direct investment towards sustainable projects and activities to achieve the objectives of the EU Green Deal, and eliminates greenwashing where companies market activities or investments as sustainable without actually making a material sustainable impact. The EU taxonomy will benefit and impact everybody within the EU, but it is only mandatory to large corporates in the EU with more than 500 employees that are already today required to comply with the EU Non-Financial Reporting Directive, or NFRD. The second are financial institutions that issue and/or distribute any type of financial products in the EU. Although it might not be mandatory to you today, you should still care and prepare, as your capital providers will reach out to you for data points. You should simply need to be ready to provide answers to the requirements of the taxonomy. But in this episode, we'll dive deeper into the CSRD, the Corporate Sustainability Reporting Directive. But before going into the CSRD, it's important to understand its predecessor, namely the Non-Financial Reporting Directive, NFRD. The NFRD explains the rules on disclosure of non-financial and diversity information by certain large companies, including sustainability reporting. The NFRD applies to about 12,000 companies within the EU region, and these will today already need to report annually on environmental matters, social matters, treatment of employees, respect for human rights, anti-corruption and bribery, diversity on the company boards in terms of age, gender, education, and professional background. But move along NFRD, because in April 2021, the EU Commission published a proposal for a Corporate Sustainability Reporting Directive, or CSRD. This one is meant to replace the current NFRD. Completely supporting the EU Green Deal targets, the CSRD will require businesses to disclose more sustainability-related information than ever. In essence, the CSRD takes sustainability reporting to the next level and aims to ensure that a larger scope of companies, about 15,000 of them across all sectors, publicly disclose even more detailed and transparent information on how sustainability issues affect not only their own business, an outside-in perspective, but CSRD also wants them to disclose the impacts they have on both people and environment, so really an inside-out perspective. CSRD has several goals and objectives. First of all, it wants to ensure all necessary information to assess a company are provided to investors, consumers, policymakers, civil society organizations, and other stakeholders. It should also help companies, mostly SMEs, so small and medium-sized enterprises, become even more attractive to investors and other stakeholders through better disclosure requirements. And last but not least, it should provide more accessible, in-depth, and verifiable non-financial data to investors that will allow for improved informed decision-making on ESG. The CSRD applies to all large companies that are governed by the EU law or established in an EU member state. including those who already fall under the NFRD. It also applies to all European stock exchange listed companies and global businesses that have operations in Europe. Here the directive defines a large company as one that meets at least two of the following three requirements: 40 million in net revenue, turnover, 20 million in assets, and 250 or more employees. The timing for the mandatory reporting will start in three phases. First of all, large companies already subject to the NFRD have to comply with the CSRD from the 1st of January 2024 onwards. The CSRD measuring and reporting requirements are obligatory in the annual reports over the financial year 2024. So basically, the first CSRD compliant annual report will have to be published in 2025. Second, those large companies currently not subject to the NFRD, having to comply with the CSRD from the 1st of January 2025 onwards. And last but not least, CSRD also will become mandatory for large SMEs 3 years later. With the new CSRD, companies will have to report on additional disclosures and extra dimensions from the Sustainability Reporting Standards, soon to be released by the EFRAG. The first set of standards, aimed to be released in October 2020, will include the guidelines on two main guidelines: double materiality and the quality of sustainability information. The second set of standards are aimed to be released by October 23 and will help companies fine-tune their reporting and addresses the remaining guidelines and the requirements for your sustainability strategy and business model. These extra reporting requirements show an increased focus in reporting on double materiality, so inward and outward impact, alignment to the Paris Agreement, and forward-looking sustainability information. For example, companies will have to report on their strategy and business model and its resilience towards sustainability-related risks and climate scenarios. This includes aspects such as stakeholder engagement, strategy fit with the climate targets, and a description of sustainability policies. Sustainability targets and indicators are another requirement. Those need to be set, and progress towards achieving them should be reported. This is important. All of this information is important because all companies who will need to comply with CSRD will start requesting information also to their suppliers, thus causing a trickle-down effect within the supply chain. Companies will have to report on CSRD in the management report instead of a separate sustainability report, meaning financial and sustainable information will be disclosed at the same time, and of course the reported information should be consistent with other EU regulations, including the EU taxonomy and the EU Sustainable Finance Disclosure Regulation (SFDR). They will also need to tag their sustainability information digitally to make it available for databases. And to top it all off, this will require limited third-party assurance on the reported information. Limited assurance is the opinion of the statutory auditor and should cover the following: whether the company has complied with the EU Sustainability Reporting Standards, the process that the company followed to identify the information that is disclosed under the standard, whether the company complied with the requirements to mark up its sustainability reporting, and whether the company's reporting complied with the requirements of Article 8 of the Taxonomy Regulation. There will be the option of moving towards reasonable assurance at a later stage when sustainability assurance standards are adopted. Before ending this episode, it's important to explain the cornerstone of the CSRD. which is double materiality, which in essence means that companies have to report about how sustainability issues like climate or environment affect their business, but also how their own businesses and corporate activities impact other dimensions of sustainability like climate, environment, and society. They need to cover not just the sustainability risks to companies, but also the impacts of companies on people and environment. I want to thank you to listening to this episode of the Sustainable Finance web series. Make sure to listen to the final episode, as now it's time to act. And I will share some concrete steps you can start taking today to prepare for the world of tomorrow.